Well, hey everyone, welcome to this podcast. This week we tackle one of the most important and underappreciated parts of managerial accounting, budgeting. Now, before your eyes glaze over like a stale Krispy Kreme, stick with me because budgeting is the blueprint that ties strategy to action. I'm Professor Jeff Byrne and I'm excited to be here with you. Here's what we're covering today: why organizations budget and how it supports both planning and control. How budgets are created, top down, bottom up, or somewhere in between. The structure of the master budget and how its components connect. Key schedules like sales, production, materials, labor, overhead, and SG&A. And we'll spot 3 sectors beyond traditional manufacturing. All of this and more in today's vodcast. So budgeting begins with defining the time frame. Most organizations plan for one fiscal year broken into monthly or quarterly budgets. Others use a perpetual budget, 12 months that automatically roll forward each month or quarter. It's like that treadmill at the gym that never stops until you jump off. Well, why do this? It keeps managers focused, always looking a year ahead, a powerful way to stay proactive instead of reactive. Planning means setting goals, anticipating needs, and aligning resources. Budgets make managers look ahead and coordinate across teams, kind of like organizing Thanksgiving dinner with 12 cousins and only one oven. Control is about comparing budgeted expectations to actual results. It's a reality check. Did we meet our goals? If not, why? Are we spending too much? Or are we way under and leaving value on the table? Budgeting approaches vary. At one end, you've got top-down budgets where executives set the targets and expect departments to fall in line. At the other, you've got self-imposed budgets where lower-level managers participate in creating the budget. This can increase ownership and accuracy, but it also comes with 2 risks. Suboptimal estimates. Managers may not have the big picture view like senior managers do. Budgetary slack. They might pad the numbers to look good. Think of it like a college student setting a goal to study 30 minutes and then celebrating when they did an hour. Well, yes, technically better, but the bar was low. So let's understand what we mean by the master budget. The master budget is a summary of the company's plans. It sets specific targets for sales, production, distribution, financing activities. It starts with sales, then drives all other schedules from sales like production, labor, overhead. All of that's in this vodcast. In the next vodcast, we'll cover the cash budget, income statement, balance sheet, all built from the initial schedules. Think of the master budget as the conductor's score for your business. Every instrument or department follows its part, but the entire composition has to stay in sync. Let's kick off the budgeting process with a SaaS company, Project Nest. They sell subscription-based CRM software that integrates client tracking, project timeliness, billing, and task management. Kind of like if Trello, Salesforce, and Slack had a well-organized baby. Customers use it to streamline operations, boost client communication, and get real-time insights for project performance. So each monthly subscription sells for $125. Projected new subscriptions are based on the marketing department's forecast, likely adjusted from last year and however senior execs want to tweak and prod it. 12,000 quarter 1, 13,000 quarter 2, 15,000 quarter 3, 10,000 for quarter 4, 50,000 altogether, 125, 6,250,000 in projected revenue for the year. But that's not necessarily cash that comes in, and it's important that we understand what the cash flows are projected to be like as well. Based on experience, 60% of the sales are collected in that same quarter in cash. The remaining 40% collected the following quarter. We'll use that pattern to prepare our schedule of expected cash collections. Now, also the company begins this budgeting period with $100,000 in account receivables, which will be collected in quarter 1 of this budget, along with the 60% of that quarter's sales. So quarter 1 has $1.5 million times 60% means that $900,000 will be collected, plus the $100,000 from account receivables. Altogether, the expected cash collection for quarter 1 will be $1 million. Now, out of this 1.5, 40% is being collected in quarter two. Don't forget that. Quarter two is 1,625,000 times 60%, or 975 for this quarter collected, plus the 600,000 in sales from last quarter, that 40%, brings quarter twos to 1,575,000. That staggered pattern continues. In quarter three, we collect 650 from quarter two, 1,125,000 from quarter three. 60% of quarter three sales totals 1,775. In quarter four, we collect 750 from quarter three, plus 750, which is 60% of quarter four, altogether 1,000,005. Add them up, and the total cash collection for this year, $5,850,000. But because 40% of quarter four sales will be collected next quarter, the company ends the year with a $500,000 account receivable balance. That's cash they'll be expected to collect quarter one of the following year. So let's shift back to a manufacturing example, this time Starlight Company, which makes office furniture. They expect to sell 90,000 units in the year, and they also want to maintain a buffer for each of next quarter's sales. So the 90,000 is broken up as these different parts. Then we'll go to the individual projected budget for production for each quarter. But you'll notice we're not just producing things that are needed for this quarter. We want a buffer as well. This buffer will be a percent of next quarter's needs and helps to prevent things like stockouts, kind of making sure you have enough dinner and lunch for the next day. Dinner tonight, lunch tomorrow, right? So we prepare the production budget to figure out how many units need to be produced, not just to meet sales, but also to maintain that desired ending level. Here's the formula. Production equals budgeted sales plus desired ending inventory minus beginning inventory equals our production needs. The amount of inventory companies keep on hand can vary by industry, but the logic is consistent. Plan ahead so you're never caught short. Let's go through the numbers. 15,000 planned for this quarter, plus 30% for next quarter, another 6,000. Altogether, 21,000 is what we want to have built in this quarter, but we already have 4,500 on hand, so less that amount means we only have to produce actually in quarter one, 16,500. 20,000 is our budget for quarter two, plus that cushion we want at the end of quarter two to meet quarter three. 30% of 30,000 is 9,000, total needs of 29. Less what we begin the quarter with. Quarter two's beginning is quarter one's end, so 6,000 comes out. Altogether, we have to build 23,000 for quarter two. 30,000 is the goal for quarter three, plus that cushion of 30% brings to 37.5, less what we already started with of 9 makes 28.5. 25 for quarter four, plus the cushion for quarter one of the next year. Not in here, but we know what that has to be. Quarter one for next period has to be a 20,000 because 20,000 times that 30% would be 6,000 that we want at the end of quarter four to go into quarter one of next year. Brings to 31,000 less what we started of 7,500, production needs of 23.5. Make a mental note here. We're going to end quarter four our year with 6,000 units in ending inventory. We'll need to determine what that value for those 6,000 will be on our balance sheet. Okay, let's walk through how to build a simple direct materials budget using an already built production schedule. So we start with how many units we plan to produce and multiply that by how much raw material is needed for every single unit. That gives us the total material needed for the production. Then we add that little cushion as well for inventory raw materials, a desired ending inventory to make sure we don't run out. Think of it as your safety stock in case demand spikes or shipments are delayed. Once we have our total material, we subtract the beginning inventory because if you already have some material in hand, you won't need to buy as much. Finally, we multiply the amount we need to purchase the cost per unit of raw material to get the total cost of direct raw materials. Let's look at an example. Smith Ceramics, ceramic manufacturer. They need 2 pounds of raw material per unit. We're just keeping it simple, just looking at one raw material item. They're starting the period with 18,000 pounds already on hand, and they want to maintain a 30% cushion of next quarter's raw material needs in their ending raw material inventory. Let's go through the numbers and see how this comes together. So production goes 30,000, 2 pounds apiece, altogether 60,000. 60,000 pounds of raw material is what's needed to meet this quarter's production needs. Plus, they want to have a cushion of raw material as well. How much of a cushion? Well, we already said. They want that cushion of 30% of next quarter's production needs, so 30% times 40,000 is an extra 12,000 they want to have on hand. They hope to end quarter one with 12,000 pounds of raw material so that they have some on hand when they start quarter two. It means the total raw material needs for quarter one are 72,000 minus what they began on hand with this quarter of 18,000. That was quarter four of the previous year's ending, which is this year's beginning, means they have to have they need to purchase 54,000 pounds of raw material. At a price of $5 a piece, total cost $270,000. The same for quarter two, quarter three. Let's look at quarter four. Quarter four's production needs of 35,000 times 2, 70,000. They want to have a desired ending raw material on hand at the end of quarter four. What is that? Oh, it's 30% of what they think they'll need in raw material total for quarter one of the next year. I gave you the number of 20,000. You can do the math and determine what that projected raw material pounds is for next period. Gives us altogether 90,000 of needs minus the 21,000 that we started with, means we have 69,000 that needs to be purchased in quarter four at $5 a piece, 345,000. Now let's look at how Smith is going to pay for those purchases of raw material. This is from the last slide, how much they have to purchase each and every quarter and the amount for the year. Now, they pay, though, 70% of the quarter's purchase in cash. The other 30% for the purchases are not paid until the following quarter. Smith also owes $50,000 in accounts payables. That was from the quarter four of last year. That has to be paid in quarter one of this budget. So the math looks like this. $50,000 to be paid off from last quarter. 70% of 270 is 189 that will be paid in this quarter. 81,000 is the balance of this quarter's purchases paid in the following quarter. 185 for quarter two. 70% of that gets paid in this quarter. The other 30% the following quarter. Altogether 210.5 for quarter two, 239 for quarter one. Quarter three's total purchases of 210 times 70%, plus the portion from quarter two that didn't get paid yet in quarter two that's being paid in quarter three of 147. Altogether, we have 202.5. Part of this quarter's purchases, 30% is paid the next quarter, which is 63,000, plus 70% of quarter four gets paid now of 241.5. Add them together, total amount of cash paid, 304.5. And make a mental note here. They purchased $345,000 worth in quarter four, but they only paid quarter four purchases so far, 70% of that, $241.5. The other 30% of quarter four, that will be an ending accounts payable balance for quarter four that will be paid off in the first quarter of next year's budget. Okay, so let's pivot to Altex Consulting. They're a medium-sized consulting firms, help companies improve operations and strategy execution. Now, unlike manufacturers, Altex doesn't stock inventory or operate machines. Labor is the product. Everything they deliver comes from the expertise and time of their team. Each quarter they forecast how many clients they'll take on, and from there they estimate how many associate hours and how many manager hours are needed for the project, because each row has its own distinct cost structure. The key is labor costs are driven by forecasted project volume, not raw materials. That makes it essential to anticipate staffing needs accurately so you don't over or under hire. Ultimately, budgeting isn't just about keeping cost in check, it's about making sure right people are in place at the right time to meet client demand. The core principle, people are the product, so plan accordingly. Let's take a look at this budget. So for the quarters, they've got estimated number of projects, 80 for the first quarter, totals for all the years of 275 projects. On average, a project takes 10 hours of associate time, 5 hours of management time. Associates are paid an average of $100 an hour, managers $150 an hour. 80 times 10 times 100 is 80,000 projected cost for associates in quarter one. 80 times 5 times 150, projected manager cost of 60. Add 80 and 60 together, Total projected labor cost, 140 for quarter one, 113,750 for quarter two, 96,250 for quarter three, 131,250 for quarter four, and 481,250 for the entire year. Alrighty, hang with me, and now let's check in with Bean Cafe, our small batch gourmet coffee producer. They've already planned production, but what about the cost that keeps the roasters running? Well, that's manufacturing overhead. Bean has two types, variable and fixed. Variable arises from production, like electricity for roasting, packaging materials, cleaning supplies. In this case, they've already estimated that's going to be $2 per unit. Fixed overhead, like rent and equipment, well, that stays constant at $25,000 per quarter, no matter how much they produce. In quarter one, they expect to produce 35,000 units. So variable of 35,000 times the $2, total variable manufacturing overhead of 70,000. Plus that fixed of 25 brings the total manufacturing to 95,000. But not all of that's paid in cash. 10,000 each quarter is depreciation, a non-cash expense. When was cash paid for the item that's being depreciated? Well, when the item was purchased. Now we're just recognizing the previous expense, previous cash outlay as an expense in the period. Sorry about that. So there's no new cash put out for depreciation. What do we do then? Well, we subtract that out of 95,000 to figure out the actual amount of cash that gets dispersed for manufacturing overhead of 85,000 for quarter one, 45, 55, 75 for the other three quarters, 260 altogether. The total overhead, well, we need to determine what the total overhead is for the year so we can come up with that predetermined overhead rate. The total manufacturing overhead does indeed include depreciation, so we have 300,000 divided by 100,000 units for a pour of $3 per unit. This rate will be used later to apply things like we did in job order costing. Now we've built our budgets for direct materials, labor, and manufacturing overhead. We're ready to pull those numbers together to prepare ending finished goods inventory budget. Why does that matter? Well, because even though these finished goods weren't sold, they still cost money to produce. And that value appears where? On the balance sheet. It also affects the budgeted income statement. How? Well, since ending inventory, when it's sold, that gets expensed out. That gets expensed out on the income statement on this line item called cost of goods sold. So to calculate this, we need to determine the unit product cost. This is typically based on the absorption method, meaning we include all direct materials, direct labor, applied manufacturing overhead using that pour. For Starlight, here's how it breaks down. Now, all this would have been calculated earlier if we were doing the complete master budget for this company. Direct materials per unit, $10. Direct labor per unit, $6. Overhead, $3. Total cost per unit, $19. We plan to build altogether 2,000 units, so 19 times 2,000, 38,000 in ending inventory. This budget helps bridge our operational planning with our financial statements, a small calculation with a big row in the financial storytelling. Okay, we've past third base and we're heading into home. Let's wrap up with the selling and administrative expense budget, or the SG&A. And we'll do so through the Atlanta Symphony Youth Program that has a youth orchestra, which puts on educational concerts and supports music access for kids all across Georgia. Even though this is a nonprofit, the principles of budgeting apply just the same. We need to plan for all of the non-manufacturing operating costs that keep the program running. We break these into two categories, variable SG&A and fixed SG&A. Variable SG&A, well, these change based on how many participants or events that they have. In this case, the program budgets $6 per participant. 35,000 participants in quarter one at $6, variable cost of $210,000. Now they have fixed SG&A of advertising of 100, depreciation of 50,000. That stays the same regardless of the number of participants they have, stays constant regardless of activity. Totals up to 150 of fixed SG&A plus our variable of 210 means total SG&A of 360. 240 for quarter 2, 270 for quarter 3, and so on and so forth with the yearly totals. But there's a catch. Not all of that is cash going out the door. Since depreciation is a non-cash expense, we subtract it to calculate actual cash disbursements. $50,000 comes out each quarter, so for quarter 1 that means cash disbursements will be $310, $190 for quarters 2, $220 is quarter 3, $280 for quarter 4, $1 million for the entire year. This SG&A budget not only supports the income statement and the cash budget, it also helps the symphony plan for donor spending, grant allocations, and overall financial stability. Key takeaways: even nonprofits understanding your fixed versus variable cost and distinguishing cash versus non-cash expenses is crucial for effective planning. Wow, I know that was a lot, and thank you so much for sticking with me. Let's bring it all together. In this vodcast, we explored why organizations budget and how these schedules support both strategic planning and operational control. We examined how budgets are built, whether from top-down mandates or bottom-up collaboration, and how they roll up into the master budget. Then we walked through each major schedule using real-world inspired companies. We kicked off with Project Nest, a SaaS company to build a sales budget and a forecast of cash collection. Then moved to Starlight Furniture for production and inventory planning. Calculated material needs with Smith Ceramics. Built a labor budget using Client Forecast at Altix Consulting. Covered overhead budgeting with Bean Cafe, including cash versus non-cash overhead. And wrapped up with the Atlanta Symphony to budget SG&A and the youth program for the youth orchestra to demonstrate how this works in a nonprofit setting. Along the way, we emphasized a few key themes. 1, depreciation does not impact cash, so exclude it from disbursement and budgets. Ending inventory value matters. It flows into both the income statement and the balance sheet. No matter the industry, budgeting, it tells a financial story, one that links vision to execution. In the next vodcast, we'll take these schedules and use them to build budgeted financial statements that'll help track performance and make strategic decisions. That's all for now. Let's go.